So I'm going to go ahead and turn it over to our next presenters, Dave and Mike from McClintock and Associates, to get the next session started. So Dave and Mike, I'll turn it over to you.
All right, great. Well, you're going to hear from both of us a couple of times today to make it maybe, if it makes it more manageable or better or worse. I'm going to do a lot of driving for this session, and Mike will lead a lot of the 9 to 10 content. I know Mike won't be shy jumping in with questions and or comments, and I'm hoping others will be as well, as much as possible in this webinar format. Kelly's reviewing the questions, and at any point we have something that we want to go through, let's please plan to do that. So we'll be going through just navigating your institution's composite score. Thank you, Kelly, for the chance to participate today. We're excited to be a part of the inaugural CFO symposium for CECU. It wouldn't be a presentation by an attorney or an accountant if we didn't have a disclaimer slide. Just this doesn't represent any accounting or financial or legal or regulatory advice, and just remember that the subject in this presentation is subject to change due to pending guidance or other changes. My plan today and the agenda for what we're going to work through is, one, to go through just the composite score basics, the components, the range of scores, the aspects of pre and post implementation definitions. I want to dig a little bit deeper into the specifics for some of those components. Just talk about, and Eileen did a great job highlighting these yesterday, some of the new requirements under financial responsibility and recalculating the composite score potentially after year end. Maybe walk through some common issues that we've seen for schools when they are preparing the school. And then finally, if time does allow, I have just a model that we can drop some information into to see how the various aspects of the composite score can impact an institution's scores based on various activity. I have to say it was a little bit interesting and challenging prepping for today's call. Typically, when we present about the composite score, I feel very confident that I understand the composite score better than everyone else in the room. Knowing today's audience, I'm not sure that is as factual. I know we spent a lot of time in it, but I also know there's a lot of people on the call who are very familiar with the score. I am interested in your insights as well, if you highlight anything. All right, so let's just walk through some of these composite score basics. Most people know, historically, this is what the Department of Education has used as a primary method to evaluate the financial strength of an institution. In their consideration for whether they need additional protection, if there should be restrictions or other additional oversight provided to a school. I'd say 15 years ago, maybe oftentimes the composite score was more likely to be calculated just of potentially just of the actual results and financial statements of the institution. Certainly now and over time, the department has really been highlighting the importance, and the most recent rules that were released highlight the fact that going forward, they expect to calculate the composite score based on the highest unfractured ownership within an organization. And so you should assume they're going to want consolidated financial statements in preparing the score. The score itself has a floor of a -0.1 and a ceiling of 3.0. As I highlighted, it gets calculated annually based on the audited financial statements that get submitted to the department via Easy Audit each year. I'm sure a lot of people.
Hey, Dave, just one quick comment, which we've seen recently. I mean, the unfractured ownership in many institutions is a fairly easy threshold to look at. And my understanding was always kind of based on common ownership, but I've seen one recently where we've done, there's a couple layers involved, and we've done it kind of at the highest layer, and it looks like ED may be coming back and asking for future audits at the middle layer, because there's the top level owns a common, but the preferred equity is owned at the middle level by another entity, and so they're considering that middle entity to be the unfractured. At the end of the day, really doesn't impact the score at all. It's just a matter of what audits that they want. So just interesting how they interpret unfractured at time and understanding it. So again, has no bearing on what the result's going to be, but just may have to change the actual audited entity slightly. So just something to maybe inquire with VDs to be certain exactly what level they want.
Yeah, absolutely. Great point. Thank you. Walking through some more of the composite score basics. Again, I think most people are familiar. There's three components of it: the primary reserve ratio, which accounts for 30% of the composite score, the equity ratio, which accounts for 40% of the composite score, and the net income ratio, which accounts for 30% of the score. Each of these components fall into that same floor and ceiling. So the lowest any score can be is a -1. The highest it could be is a 3.0. To calculate each of these scores, and we'll walk through it, there's a ratio for each of these, and we'll go through what makes up the ratio for each of those three components, times the strength factor, and then times the weight, the 30%, 40%, 30%. So obviously, based on these ratings, it's always possible, now it may not be feasible, to contribute enough equity into the entity to pass the composite score, because the primary reserve ratio and the equity ratio, as we're seeing, are primarily driven by the equity that is in the company. And so they make up 70% of the score. 70% times that 3.0 is a 2.1. And if the net income ratio is 30%, the most it could be is a -1 times that 30% is a -0.3. So that would equate to a 1.8. So just something to keep in mind as we go through the calculation.
And I was going to say, and I think, I can be critical of the department at times. This is one of the things I think that the ratios are good at, that you can lose money. And if your equity is strong enough, you continue to pass in any given year, assuming those losses don't accumulate at too big over time to reduce the equity. But they are given credit that 1 year blips can be a problem, but not risk failing the composite score. So that's one thing I do like about the ratios.
Right, there is one thing. I knew it was out there somewhere. Again, just quickly some of the basics. So there's basically, I'd say, 3 buckets or 3 levels of the composite score. So having a score between 1.5 and 3.0 is considered to be passing. If the score is between 1.0 and 1.4, it's considered to be in the zone. And then scores between a -1 and a 0.9 are considered to be failing. Of note, a school can only be considered to be in the zone if the prior year score was passing. So if you had a score of 1.8 and it goes to 1.2, the institution is considered to be in the zone, and there are some zone alternative requirements that can be elected. However, if a school fails a score, if your score is a 0.7 and it increases to that 1.2 that I had in the original example, the school would still be considered to be failing. It would have to get all the way back to a 1.5 before it's considered to be passing. So the people are aware the department could require a letter of credit equal to a percentage of the Title IV that was awarded during the fiscal year. There could be growth restrictions potentially. There could be some kind of heightened cash monitoring that could be required as a result of failing the composite score. Work through the final of the composite score basics, and this goes back probably, I guess, 3 years ago. There's 3 types of inputs that need to be designated as being pre-implementation or post-implementation, and we will walk through some of those definitions somewhat briefly. The 3 are property, plant, equipment, so just PP&E, long-term debt, and then the balances that are associated with implementing the lease standard that many private companies did for the first time in 2022. Some of the private companies were required to do it earlier than that. So let's take a look at each of these and make sure we're all on the same page for how they are determined. So first, pre and post implementation. So it was initially designated that the PP&E and debt amounts were going to be set by the last audited financial statements that were submitted prior to July 1st of 2020. So based on this, this means that for most schools, and I'm using a calendar year end as a fiscal year end, but for most schools, that meant the balances on their 2019 financial statements for PP&E and the long-term debt were included as pre-implementation. Now, there is a catch, as everybody I'm sure remembers. Early 2020 was when COVID first hit, and there was a COVID waiver, and there was an extension granted beyond the 6 months typically required for audited financial statements. The catch is that by utilizing the waiver and submitting those statements after the 6 months, so after July 1st of 2020, that means that the last statement submitted for some schools prior to July 1st of 20 were actually the 2018 financial statements, and that was what was used to memorialize those balances. For the lease standard, I'm sure people are aware, the required implementation continued to be delayed. There was some pushback in the composite score. I'll walk through the impact that having the right of use assets had, and the department as a olive branch, I don't know, was to allow schools to include leases that were in place prior to December 15th, 2018 as being pre-implementation leases, which get treated slightly differently in the composite score, get treated a little bit more like the PP&E and the debt relationship with one another. You gonna say something, Mike?
Yeah, and just kind of reminding everyone where the pre and post implementation came from was in the bar defense to repayment new rulemaking they did. I can't remember if it was 17 or 18. Department had to have a fix for the lease standard, so they created the subcommittee to vet through different options. And what department came up with was different than what she went through NEGREG, but the idea was you've made business decisions based upon the leases, right? And so how do we grandfather in business decisions that you've made versus new business decisions after you're aware of the lease impact? And so that's where they came up with this pre and post treatment, and then did the same thing with debt. You know, they did not like how debt was being used in the primary reserve ratio that Dave will walk through. But again, if you already had debt in existing, they were going to grandfather it and allow it to caveat, and then change the treatment of the debt in going forward, partly due to the Corinthian debt issues that came out from the OIG. So that's why they came out with these pre and post implementation items. And eventually the pre is going to go away is the idea. It was just the transition period, and it will vary depending on each school of when it goes away.
Thank you. I'll try to work through each of these somewhat briefly. So the PP&E was set by the net book value in those qualifying statements. And so that becomes the initial balance. And then going forward, you are required to track the depreciation of those specific assets that were included in the net book value as of that qualifying statement date. And then obviously any disposals of those equipment, you have to track that balance on a roll forward basis for PP&E. And as Mike was alluding to, so eventually those will all go away as they're either fully depreciated or disposed. The long-term debt was also set as the outstanding balance in those qualifying statements. It gets reduced by any future principal payments against the balance in the initial debt. It is possible to refinance a long-term debt that is considered to be pre-implementation debt. However, if you do so, it is crucial to ensure that you don't finance even $1 more than that initial pre-implementation dollar amount. We do think, and have seen the department's opinion, that it could impact the ability to incorporate that debt as long-term debt and add it back up to the PP&E without having it specifically tied to the acquisition of the PP&E. And we'll walk through the impact that can have on the composite score. And then finally, just the pre-implementation considerations for the leases. So any leases that were in place as of December 15th, 2018, without amendment or adjustment. So as I highlighted, this became, I think, a little bit more complicated for some schools because it didn't actually end up implementing because of the continuous extensions until 2022. So the initial consideration was that it would have been for the year, I believe, 2019. So right after this year happened, there were 3 years of activity. And so you could have adjusted leases, expanded the space, decreased the space you were utilizing, exercise an option on the space, which all could have hindered the ability to include it as a pre-implementation lease. There are two key benefits of leases that are considered to be pre-implementation. One is, as we'll walk through, the primary reserve ratio. The add back for these lease liabilities is not capped by the amount of pre-implementation ROU assets. And then the equity ratio component, the pre-implementation ROU assets, you can subtract from your total assets, which is not available for the post-implementation, and we'll walk through that. Through it, as I mentioned here, you are required to record the future extension options when implementing the standard initially to be considered as pre-implementation leases. For the post-implementation consideration, so really two buckets going forward for the PP&E. So one bucket is any fixed assets that are obtained through long-term debt to finance it, and then also fixed assets that are obtained without any debt. And then similarly to the bucket that we talked about for pre-implementation, you now have to track each of these so you have the balance, and then they get reduced by, I guess, future acquisitions, any depreciation on the assets designated with long-term debt or without, and then disposals within those. So it's important to track all those buckets independently. Going forward, long-term debt post-implementation really gets designated as either qualified or unqualified. And the qualification consideration is, was this debt obtained specifically to acquire fixed assets? If so, it's considered to be qualified, and if not, it is considered to be unqualified. And this did put end to the practice that the department found issue with of long-term debt just being added near the balance sheet date, because it was a way to improve an institution's composite score. And so this was meant to close that loophole and acquire the debt to be attained specifically for the fixed assets if it's going to be included in the add back for them. And then finally, the post-implementation consideration for leases, any new leases entered into after the initial implementation, and then any leases that have adjustment after that initial implementation. So we talked about adding to or reducing the space, exercising options. If there's other amendments to the lease, then it would then be considered a post-implementation lease.
Yeah, I was gonna say that the key item that hopefully leases that you had renewals on that was reasonable and supportable under GAAP, to add for your pre-implementation. You did that last year because it really was, there was the 12/31/22 or 6/30/23 audits. Because at this point, if they're not in your right to use asset and you now exercise that renewal, it makes it post-implementation. The other thing department said in one of their Q&As is when you sell the school, all the leases become post-implementation because you've made a new business decision. So even if those just get assigned to the new owner and basically continue on at the same terms, from department standpoint, they've all become post-implementation. So just something you've got to track and be aware of that will look different under the new ownership.
Thank you, Mike. And I'll pause to take a breath, and Kelly, just make sure there are any questions that we should answer to this point. And if you
are
don't say
all set. Yep, you're all. Oh, you know what? We do have one question that just came through. Has an industry accepted spreadsheet been developed that can be downloaded to ask the user for financial data and then calculates the composite score automatically?
So we, and I'm guessing there's other representatives of firms who work with in the space, have a model. It's not available for download. We certainly work to be very proactive with our clients and project it before the end of the year, and we'll be happy to review calculations and have actually done the same for other schools, or to review a calculation they've prepared, but I am not aware of anything either from the department nor from any other firms that can be downloaded and utilized.
Oh, Mike, you're on mute.
Sorry, I went the other way. I know from talking with the OIG over the years, the department is not gonna create any type of 90/10 model, composite score model. They're gonna issue the regs, but they don't want to create a model then for people to use. That's on the schools or the practitioners in the industry.
Great. We have one more question that came through. Will change of ownership affect pre-implementation PPE?
I'm just thinking through the Q&A. I don't think department addressed that specifically. What I've seen on most change of ownership is the debt usually gets paid off and new debt's incurred. So it kind of, if there was pre-implementation debt, it's most likely to go away. I've not seen a deal where the debt has been maintained. I'd have to think through that. My guess is if you follow their logic, that's a new business transactions, it might be hard pressed to keep it as pre-implementation debt after a change of ownership. But they weren't specific on that. I mean, I think that's the reason why almost the whole company's getting reset at that point in time.
We are aware of deals though, where if there was debt as part of the transaction, that part of that debt was assigned to the acquisition of the fixed asset of the target. So it's almost like, or could be in essence, converting it from pre-implementation with debt specifically assigned to it to post-implementation with qualified debt is a way that you could continue that, I believe.
Yeah, because in either scenarios, Dave will walk through, the debt can never exceed the PP&E amount in the primary reserve when you add it back. So whether it's pre-implementation or qualified post, the impact is going to be the same.
Great, thank you.
Yep, thanks for the question. Then jump in at any time, Kelly. Thanks. All right, finally, we'll get to primary reserve ratio. So in this case, the ratio is the comparison of adjusted equity, which we will walk through how adjusted equity is defined, to the total expenses for the fiscal year. The strength factor for the primary reserve ratio is 20. Factors that help or improve the primary reserve ratio, obviously equity, because that's in the numerator. As we went through, just any long-term debt that is associated with PP&E, so that could be pre-implementation debt with pre-implementation fixed assets or qualified debt, and then the lease liabilities, and especially those that are considered to be pre-implementation. The hurdles are the things that can negatively impact it. The biggest, especially post-transaction, is often goodwill and or intangible assets. See it a little bit less frequently, the unsecured related party receivables, any fixed assets without long-term debt associated with it, the ROU assets and distributions, which are obviously decreasing the equity. In the numerator, hopefully this is big enough for people to read. This is a model that we have just to calculate the adjusted equity. So you begin with the total equity in the company. Again, as I just walked through, you subtract goodwill, you subtract intangible assets, you subtract any unsecured related party receivables. Those are all pretty much straightforward, can come right from the balance sheet. Some of these other inputs need to be often disclosed in the footnotes and then again in the supplemental schedule that everybody has been preparing. So you subtract out pre-implementation right of use assets. You also subtract out the post-implementation right of use assets. So those would typically just be reported as a single number on the balance sheet. The footnotes would break out into those two. Then you would have the total property, plant, and equipment net that is on the balance sheet. This is where we have to get into some of these add backs. And so there could be debt. You can add back the pre-implementation debt, but the amount that you can add back is capped by the amount of pre-implementation PP&E. So if you have $100,000 of pre-implementation PP&E and $120,000 of long-term debt, you can only count $100,000. If you have $80,000 of debt, you're going to add back $80,000. There'll be a $20,000 reduction from your total equity because of the difference in those two numbers. You can also add back the post-implementation debt that is specifically obtained to purchase post-implementation fixed assets. You do get to add back the pre-implementation lease liabilities. Note that the regulations did not seem to outline a cap associated with this, and this is why the pre-implementation can be so beneficial. There are often cases where the lease liabilities will exceed the right of use assets. So it's possible that a company could have, now they would have already been reported to this point, but you could have pre-implementation right of use assets that are less than the lease liabilities. And so you would be increasing the adjusted equity by that spread. So he came off mute, Mike. I didn't know if you had something to say.
Yeah, just the department's theory was you're throwing the pre-implementation assets and lease liabilities out completely as if they didn't exist. That's the whole benefit that you're getting. And again, normally those liabilities are a little bit higher, and now they're going to wind down over time as well and go away. But certainly there's a benefit at this point in time still.
And then the last add back is the post-implementation lease liabilities, but they are capped by the post-implementation right of use asset. So that's our adjusted equity. That's a numerator. I think the total expenses are pretty much straightforward. There could be a change if you have investment losses or other things that you might have typically grouped with expenses that wouldn't be included. Now, as far as the key benchmarks for the primary reserve ratio, because the strength factor equals 20 and we are comparing the adjusted equity to the total expenses, what does that mean? What percent of total expenses does the adjusted equity need to be to hit some of the key amounts in the composite score? So for example, if you want the primary reserve ratio to be at the ceiling and contributing 3.0, which would be 0.9 because 3.0 times at 30%, that means your adjusted equity must be at least 15% of your total expenses for the year. Work through, I have 1.5 on here because that's obviously the floor for a passing score. So they have to be 7.5% of the total expenses. If they're 0, obviously the score is 0. So it's at least not hurting the overall composite score. And then finally, if adjusted equity is -5% or a greater negative of the total expenses, you're capped out at the -1. So if you have negative equity, accumulated deficit, you have to get to at least -5% of your total expenses before any additional equity would begin to contribute to the composite score because of the primary reserve ratio. All right, that will move forward to equity ratio, going through some of the same statistics. So modified equity over modified assets, 2 different calculations. We will walk through that. The strength factor is 6. Again, the helpers are the equity and pre-implementation lease liabilities. We'll walk through why. The hurdles are very similar. Goodwill and tangible assets, unsecured related party receivables, right-of-use assets, and distributions. So quickly, if we go to the modified equity, you will note that the difference between the modified and the adjusted is the removal of the subtraction of the fixed assets with the add back for any debt that was used to obtain those fixed assets, or both being pre-implementation. We do still have the adjustments related to pre-implementation leases, so the assets and the liabilities and the possibility of receiving a benefit from that. The big thing could be the modified assets as we walk through that. So you begin with your total assets. You are able to also subtract out the same goodwill, intangibles, and unsecured related party receivables. The impact is primarily you are only able to subtract pre-implementation lease liabilities from your total asset number. So this is where post-implementation leases can hurt the composite score because we are increasing the denominator in the modified assets by those right-of-use assets. So bigger denominator decreases the score. So if I move on, strength factor here in this case is 6. So again, the percentages that modified equity must be as a percent of the modified assets to achieve certain scores. If it's 50%, you have 3.0. If it's 25% of 1.5, you can go all the way down to a -16.7% is the floor. And if you're below that floor, you need to get at least to that point before it would contribute anymore. I will say this can be a pretty crucial number and something worth looking at in these percentages, just because the equity ratio is the largest piece of the composite score. It does make up 40%. And if you are at a 3.0 for the equity ratio, that equates to a 1.2, which is certainly well on the way to a passing score of 1.5. And without too much hindrance from the other 2 scores, at least the possibility of being in the zone if you had a passing score in the previous year.
And I think what we've seen is, if you think about school balance sheets, they're not asset intensive, right? I mean, most of you don't own a lot. So when you put on that post-implementation right to use asset, especially if the lease is getting up around 10 years, it just has an outsized impact on this ratio just from the nature of the industry. It's not, phone companies own all these cell towers. It's a service business, so the balance sheets tend to be a lot of current assets, liquid assets, and not heavy assets. And so what we've seen is for schools that have an impact as a result of the new lease standard, it tends to move it from 0.2 to 0.3. So if you were at a 1.8 and that lease is getting around 10 years and the equity is not super strong, it could certainly move it around to a 1.6, possibly a 1.5. If you're close to a 3.0, it has less impact because the equity is already strong. But that's what you've got to keep in mind. And you may have seen that last year for our financials, or maybe you didn't see it last year, but this year is not as profitable. You certainly want to start looking at that because it has made some clients who've had to do some planning because the score was much closer than they expected after the adoption of the lease standard.
Yeah.
You're on mute, Dave.
Thank you. Yeah, I might end up repeating myself but later, but that's also the major impact after a transaction related to a school. It's a service business. There are not a lot of hard assets. And so those transactions tend to create a significant amount of goodwill or intangible assets that are getting subtracted out of the equity for both the primary reserve.
Yeah, and you add on all the leases as post-implementation. So it's kind of the worst case scenario the day after the acquisition from a composite score standpoint.
Yep, absolutely. Slide into the third component, which is the net income ratio. And so this ratio is the income before taxes over total revenues. The strength factor in this case is a little bit more complicated, the 33.3 times the ratio, and take that product plus 1. Obviously, for a net income ratio description, profitability is the key for this. Just some additional considerations. Typically, losses from discontinued operations can be excluded from the net income in this calculation. The investment losses can be added back, do not need to be included in the net income. However, typically other comprehensive income must be included in the net income component.
Yeah, the department made the other comprehensive income kind of more clear after those changes that came back in 2018, 2019. They actually had a conversation with them and they said they've always included it. I just don't think it wasn't clear, but it kind of made sense because nonprofit entities don't have the concept of other comprehensive income. So if they have, some of the changes in investments or interest swaps, those go through net income. And so they want to include the OCI for the things that are applicable for-profit schools. So then you're comparing apples to apples. So understanding that was helpful. And say we've seen a lot less of that recently. Some of the changes in the standards and certainly the interest rate swaps we've seen have kind of gone away. So we've seen a lot less of other comprehensive income and haven't had to worry. And these items, every time they come up, I just always go back and double check the rules because they don't come up enough. I'm 100% certain on. So just revisit them if you have them every year.
Absolutely. Thank you. Didn't mean to jump ahead. I was trying to make sure I was in the presentation. The strength factor here means that net income as a percentage of total revenues must be the following. So if net income is at least 6% of your total revenues, you will be maxing out the net income ratio at a 3.0, which would contribute 0.9, right? 3.0 times 30%. If it's 1.5% of your total revenues, you're in a passing score of 1.5. If you have losses of 3% of your total revenues, it would actually lead to a 0 for the net income ratio, 0 score. So it wouldn't be at least subtracting from what you're getting from equity in the primary reserve ratios. And then finally, the floor is losses of 6% of your total revenue. So once you hit a 6% loss, anything below that would no longer hurt your composite score. Obviously, would continue to impact the equity, which is a key piece for both the primary reserve and the equity score, but it can't be the net income score can't get any lower due to losses above that amount. Any more questions, Kelly? I'm about to switch gears into some of the new financial responsibility requirements.
Not at the moment.
All right. Thank you. Just talking about some of these new rules. The department is going to require recalculation for the prior year composite score ratio for certain claims, settlements, than BDR claims. The calculation will be simply adjusting the equity that was included on those balance sheets based on the amount of the claim settlements or BDR claims as part of that. Potentially equally importantly and more importantly is a new calculation. I know it's been talked about a bunch. It was debated quite a bit during the negotiated rulemaking, but it's the new requirement that a school basically is required to monitor its own composite score. And the monitoring is for any distributions that are made in the first 6 months of a fiscal year. You're required to consider whether or not there were equity contributions in the fourth quarter of the prior year up to that dollar amount. And if so, you must recalculate your composite score, removing the equity equal to the amount that was distributed after the end of the fiscal year. If it does force your score to now be below a 1.0. So it's something to track and be aware. I just want to be very aware of contributions being made, considering making those contributions a little bit earlier in the fiscal year. And clearly the intention, I think, is pretty clear by the department. They're trying to avoid equity being contributed prior to the balance sheet date, simply to pass a composite score and then being distributed either soon after the end of the fiscal year or right after the reports are issued.
So I think the one Dave just talked about has a couple points on it. One is it does give, department has been going back and recharacterizing contributions. Eileen talked about that yesterday, where we've seen people put money in and take it out after year end, and departments say, you know what, this is just a short-term loan. So by locking that date in to say, I'm going to put money in the fourth quarter and take it out in August of next year, department has almost provided the safe harbor, though, too, that if you leave it in, we will no longer recharacterize it. So there's good and bad with this item. Obviously, there's a cost of leaving it in, but maybe some safety, knowing at some point you take it out, then maybe you're not going to need it the next year. Profitability is improved. I can get it out after July 1st, and I will be safe. So there is good and bad. The one thing, and I've read it a couple of times, and I'll read it again, is they talk about any equity coming out. So if you put equity in the fourth quarter and you're paying preferred dividends in the following year, that counts as well. So it's not just the capital, it's the dividends. And so, for clients in equity group situations, that's going to be an issue to look at if they're contributing capital and now there's a return associated. Now, maybe the return doesn't drop you below a 1, but you have to consider that. And so that, because they said any form of equity withdrawal. And so these are things that, for those of you in those situations in 2024, it's have to start reading these rules closer as we start looking at composite score projections heading into next year.
Yeah, I just would highlight that it does include any distribution, even if for tax purposes, for a pass-through entity. There used to be a requirement once if you're in the zone and distribute or make a distribution, you're required to report it to the department, but there was a waiver if it was being made for tax purposes, and that consideration is no longer part of this reporting requirement.
I've got some owner-managed schools that are also considering, at some point, do they put some investments in, right? Do they leave some more permanent equity? Obviously, with investments, you run the risk of market value fluctuation, but is it cash? Is it T-bills? Is it securities that are lower risk at some point if they've got the money personally, of just saying, all right, maybe I've got to leave more equity in the company at this point in time because of the new rules. And so those are things to consider as well. And you can, I think, do that without hedging too much risk for the company, just shifting where those assets are instead of holding them personally, which is kind of the idea of pass-through entities, right? You'll be able to take the money out from a tax standpoint, but the department is a regulated entity saying, we don't want you to do that. So it's just maybe realizing you're going to have to maybe transfer where some of that capital is held so you don't have concerns with the ratio.
Thank you. And with that, I'm going to jump into just some of the common issues that we see. So hopefully the result of the last was to provide some perspective of where to test the composite score and understanding of where the various ratios can be impacted, where you can get the most bang for your buck if you're trying to improve it. So common causes for decrease to the composite score compared to the prior year. probably the most significant is operating losses, because obviously that can hurt your net income ratio, but it also reduces equity, ignoring any other action or contributions that are made. So that is the most impactful activity that can occur that hurts the composite score. Obviously, distributions that exceed the profit, so now you end up with less equity than you had the previous year. Purchasing fixed assets without any qualified long-term debt associated with it. New or amended leases that could lead to sometimes significant increases to the total assets, and I walk through why that does increase, or why that does impact the equity ratio, or the equity ratio, excuse me. That's the total assets in the denominator, and then any change of ownership that doesn't have debt, because you have all these would have PP&E. You could be losing pre-implementation considerations for variety of items.
Hey, Dave, one thing, I think where I get a lot of questions is related to lease build out. So if you think about a lease build out and you're getting a TIA, that's going to decrease your right to use asset. But then you're going to have the PP&E that's not going to have any debt offsetting it. So where we've talked to clients is maybe borrowing, as they've said, for that. So then while I'm lowering my right to use asset, and I'm taking on the build out cost, but I've got debt to offset it. That, or is a way that the landlord does the build out for you. Now that's going to increase your total rent most likely, but you're going to have the lease liability as an add back to the higher right of use asset. So what you don't want to have is an asset that doesn't have an add back in either the form of debt or the lease liability. So as you start getting into opening new locations or moving new locations, thinking through how you're going to finance that through the lease is worthwhile conversations with your accountants and CPAs. Dave, you're on mute.
Thank you, Mike. I'm so glad you're here. Thank you for that. I think we will have time to go through some very simple examples just for how the impact of some of those could be. Just common issues when projecting the composite score. A lot of this tends to be based on the size of the entity, and then also just some monthly accounting accruals that get performed. I mean, it's basically tied to some of these cash. I'm calling them cash to accrual considerations. Also, a lot of it could just be tied to, obviously, if you're running a school, you want to be monitoring the operations and the cash flows more so than the impact of some of these other items. So, for example, we've seen hiccups related to a new lease that might have free rent, and so maybe you only record the lease standard and do a true up at the end of the year, but you're recording the rent expense based on the cash payments that are made. So you could have an inflated profitability during the year. You're going to jump in and say something, Mike?
I was going to say also just a related party. If you do have related party receivables, continue to be certain those are secured. That you've got promissory notes for them, you've got investments or assets outside of the company that you're securing them. We've seen ED ask for them and also accept them, but I think you want to certainly have all that stuff papered and done timely, and you don't want to be scrambling after the fact. The stuff you really want to have planned before year end, so you can justify and support that there are assets available to pay off those related parties. And if you can pay them off, that's even better, right? If you can pay down those before year end.
Yeah, absolutely. And this goes back quite a while, actually, but they were asking for the UCC filings perfection. We did push back at times saying, can you point out where in the regulation it says this is required? But that would be the ideal thing to do. I consider some of these other things to be cash to accrual, even though they're not technically. So just some schools don't look at their receivables and the consideration for the bad debt expense or the write-offs and do it once a year end. So just considering that. If you're entering into new leases, make sure it's important to reach out either to calculate it yourself or reach out to your auditor to make sure you know the dollar amount that the right of use assets will be as of the ending balance sheet date, and understand what that impact will be on your score. And then if you're doing preliminary projections, so maybe you've closed the books through September, just remember when preparing that calculation that total expenses is the denominator in the primary reserve ratio, and total revenues are the denominator in the net income ratio. So using, in that case, 75% of the final number could artificially inflate the score. So it's important to do something to annualize those.
Guys, we do have a question going back to the last slide that you were just on, just a clarification. Does that mean we should add BDR claims to our composite score calculation, or just that DOE will include those in the recalculation of our score?
So I have to go back and reread that trigger again. What I think they're getting at would be BDTR claims have been adjudicated and that they would probably have assessed to the school. And we've got different levels of BDTR claims. So it would only be ones I think that would be making the school repay is what my indication. So that would only, I think, be the new rule or the ones that are now following under the new rules. And I'm not a BDTR expert. I'd almost have to call the attorney and say, hey, what do you think these go in? So at this point, because someone else asked me this, we are not taking composite scores and saying, here's all your BDR claims, let's factor that in. But if they do approve them and then come back to you with a liability in between audit years, at that point, they're going to say, okay, we're going to assess on the composite scores, is my understanding of how that's going to work.
And I would agree. Any other questions? Not, that's my.
I believe those are the only questions we have so far.
Okay, that works. Can you confirm, do you now see a spreadsheet?
Yes.
All right. So this is just a very simple example of a company. So I guess a relatively small balance sheet with $2.5 million of assets. You can see I have 250 of pre-implementation fixed assets. There's no debt associated with that. They have $300,000 of a right to use pre-implementation lease life or right of use asset related to leases. So maybe they were most of the way through a lease and it decreased it. I made the lease liability equal to that. $400,000 of equity. They're having a tougher year now, as a lot of schools have, just in investing in instructors and marketing and all the regulatory. So $250,000 profit and total revenue of $8 million. Pretty simple projection you can see here. So right now their primary reserve is 0.1, equity is 0.4, net income is contributing 0.6. So they would be at the end of this year at 1.165, 1.2, but they would be in the zone if they had a passing score for the previous year. And walk through a couple different situations, solutions, and then impact that this school could have. So first, if I plug in $215,000, which is a relatively significant equity contribution compared to what is already in the company. If you follow this column H, you can see I get them to a 1.5, which is just in the passing. Now, technically, the composite score is considered rounded to a 1.5. So where does it go? It could put in 180,000 to the 1.453, which would round up to a 1.5 and considered to be passing. I mean, this is always. Okay, go ahead.
I'd say as an auditor, I'd prefer to put a little bit more in and not come out of 145 because you have any journal entry the wrong way. My palms are sweating if that's the number we're relying on.
I would say absolutely, and it also avoids an interpretation from the department or something else that would question it. I agree 100%. But as I highlighted at the beginning of the presentation today, I mean, adding equity is always the surefire way to improve the score. And there's always a number, there's always an amount of equity that can be provided. It's just whether it's accessible becomes the question. All right, so second example, just some of the impact. So in my example, the right of use asset lease liability was 300,000. Maybe they're pretty close to the end of that lease, and so they're moving into a new lease. Maybe it's a longer lease, or they moved in a new space. And I'm going to say that the new implementation model is 1.4 million for the post-implementation right of use assets. If you follow what I'm doing here, I'm just increasing the liability by the same amount. That's not actually how the model works. It's close enough for this work. Now it's important if you do this to make sure that you are flowing through to increase the total assets by that same dollar amount in the way the calculation works. And if we look here for this company, now they're going from being in the zone to, I guess, technically rounding to a 1. I would not want to be rounding to a 1 in this situation. The school could be failing as we get entering into a weak spring space. And then let's say in this case, if I adjust this, maybe it's a shorter lease. We're only going to add $1 million for the right of use. But in the first case, we need to build out this space. So we're going to add $75,000 for leasehold improvements for this new space to be inhabitable. And so if I put that in without debt, so we can see they're barely passing. I'm in this model, we can see the impact that they take them below 1. I realize it rounds, but this number could be slightly bigger. So that's obviously the impact. Now, if we are purchasing it if we're obtaining the fixed assets using debt, then there is no impact on the composite score. So that's obviously important to know. It's important to get that financing lined up prior to purchasing the assets. We would certainly recommend ensuring that the debt is secured very specifically by the assets that are being obtained with these leasehold improvements. And just highlighting the impact as well. If I do this, so we can see the score of 0.97. If we do have $1 million of leases and we have fixed assets obtained without debt, if I put in $400,000 of equity, I can get my score all the way up to above a 1.5 from adding it and just kind of walking through what the impact can be if you're acquiring it with debt. It does reduce this amount by about $50,000 by using the debt to fund that acquisition, which makes sense. So we're saving $50,000 that we're contributing and using the bank debt to purchase the fixed assets in addition. So again, I know these are just some very simple examples. There is not a model I'm aware of that can be downloaded. I certainly can walk through this with anybody who would be interested in reviewing your results or projections or reaching out to your auditor. Everybody has a model they use to work through it. It is crucial to make sure that you're making these considerations prior to year end, especially for the equity contributions. It is especially difficult to get those incorporated if the cash has not been put into the company prior to the balance sheet date.
And thinking through the debt, the department doesn't say the debt documents have to specifically indicate it. I'm not sure banks lots of times wants to embed in there what exactly the capital's for, but certainly anything I have seen where people have had agreements that said operating use only. So that's clearly would taint that because it's obviously not allowed to be used for equipment. Where we've seen it's been pretty easy is if someone doesn't have any debt and they build out a new location and take on a term note just for the build out. I mean, that's pretty easy to tie that debt to the build out. The other one is people using leases instead of buying equipment. Capital lease is basically the same thing, or now it's on the balance sheet. Or just having an equipment note with the bank that maybe you can make multiple purchases during the year, then it terms out end of the year. I've especially seen that in some trade schools that are capital intensive. I think that's a pretty easy link to say this debt, here's the equipment we bought during the year, and then it rolls into a 5-year repayment. So as long as you're planning and structuring up front and your footnotes are clearly disclosing it, they want to see it in the footnotes. If you don't indicate in the footnotes the statements that this debt was used for, they're going to deny it and you can't go back. So we haven't had ED ask for backup yet, but I haven't had them challenge anything that's been in reports yet either at this point in time.
Thank you. And then just lastly, QR code that you can use to scan. So we try to be as proactive as possible, providing thought leadership, getting ahead of the issues that proprietary schools will be facing. And so we have a blog with articles and also some additional resources on the page. If you scan this QR code, it'll take you to a spot where you can find a sign up for that newsletter. Also captured here just some basic contact information for both Mike and myself, if you want to reach out to either of us with questions, we would be happy to address those with you. And then finally, I would be remiss, especially as Jason Altmeyer will be participating. We're hosting a virtual compliance workshop next week, 2.5 days on Tuesday and Wednesday, walking through GLBA for the current state of the political situation with Jason, BDR claims, and some other items. And certainly on our website, you can find that information or reach out to me or Mike. We can help you with that as well if you're interested.
Great. Thank you again to both of you. I'm going to switch my screen back. And so we do have the pleasure of having Mike and Dave join us later this afternoon for a second session at 2:45. So feel free to continue to type out your questions in that chat box. And if we don't get to it right now, we will definitely bring those back up at their later session. So once again, we're going to take a quick break, about 15 minutes. And the next session will start at 1:30, which is best practices in student collections with tuition options. So thank you again to Mike and Dave. We will see you in a little bit for the second session. And for everybody still on the line, feel free to close out if you need to and use the same link to log back in, or you can leave the window up, and we will see you back at 1:30.
Thank you so much, Kelly.
Thanks, everyone.